Good morning. We will take up today piecemeal distribution. What is this piecemeal distribution? So far as the insolvency or you can say the dissolution of a partnership firm is concerned, we have assumed that all the assets will be sold on one day and all the liabilities will be paid and the accounts will be settled in one day. But practically it is far from true, because the gradual realization will be there. Today something has been sold, tomorrow something has been sold. So, as and when we are receiving some cash, including the cash in hand and cash at bank, we will have to give it first to meet the realization expenses, then to the secured creditors, then to the unsecured creditors, then partners loan account ratably and then partners capital account. So, this thing can be done under two methods. One is your proportionate capital method and another is maximum loss method. Today first of all we will be taking the proportionate capital method on a problem, then we will take up another problem on maximum loss method. So, if the capitals of the partners are in the ratio of their profit sharing, then there will be no difficulty each of them is paid out according to his capital ratio, because the capital ratio and the profit sharing ratio are same. But if the capitals of the partners are not in the profit sharing ratio, the first cash available after making payment of outside liabilities and loans due to the partners for distribution among the partners should be paid to those partners whose capitals are more than their profit sharing ratio. That means, we have to compare according to the profit sharing ratio who is having more capital. The man or the partner having more capital in proportion to his profit sharing ratio should get the first priority to receive back the money. After this, the cash available is distributed among all partners according to their profit sharing ratio. Once that has become labeled according to the profit sharing ratio, the capital becoming equal to the profit sharing ratio, then only whatever remains that will be distributed according to profit sharing ratio, or at that time capital ratio is same. The unpaid balance of capital accounts will represent loss and realization. Whatever amount we cannot pay due to deficiency, that will be the ultimate loss, and that loss we have to ensure that is the realization loss, and as usual realization loss should be as per the profit sharing ratio, that we have to ensure. So, here we are taking a problem where ABC 3 partners are there and their profit sharing ratio is 3:2:1. Suppose their profit sharing ratio 3:2:1. On the basis of this, here is the question. A's loan account creditors are 50,000. We can say amount due the creditors are having 50,000, A's loan 10,000, then capital accounts of A, B, C 50, 10 and 40. Then we have got land and building 70,000, plant and machinery 40,000, stock 25,000, debtors 20,000, cash 5,000, total 1,60,000. But we are more concerned with what is the realization. First of all, the realization was first realization was 40,000, then second realization 30,000, third realization 54,000, fourth realization 7,000. Prepare a statement showing how the distribution should be made by using proportionate capital method. So, when first realization is 40,000, first of all cash is 5,000. We have got cash 5,000. So, all total it is coming to this much. First of all, we will be giving 5,000 rupees cash to the creditors. So, what is remaining is 45,000. then this is continuing 45,000. Then the first realization is 40,000. So, entire 40,000 rupees will have to be given to the creditors because they are outsiders. So, remaining is again 5,000 due. Then we are having second realization 30,000. Second realization is 30,000. How we are distributing this 30,000? 5,000 first of all we will give them. So, we have got 25,000 rupees with us, and out of 25,000 we will give 10,000 to the loan account. So, that will be repaid completely. So, minus 10, that is coming to 15,000. So, this 15,000 rupees will have to be given to ABC in their ratio. But which ratio? First of all, we will have to see that if A has got 50,000 for 3 shares, per share he is having 16,667 rupees. B is having 10,000 for 2 shares, so per share it is giving 5,000. And C is having 40,000 and his capital is 40,000 for 1 share. So, you can see per share how much each one has contributed. Now, who has contributed maximum? C has contributed maximum 40,000. So, who will they will get, or say C should get at least 40,000 minus 16,000, if not 5,000, let him give 16,667, just the proximate one, that is 6,667. So, up to 333 and 23,333 he should go on getting. So, now he is getting only 15,000. So, give him 15,000 here first, so that the second realized 30,000 has been exhausted, 5, 10 and 15. Okay, now, we will come to the next realization. Out of 23,333, he has received 15,000. So, he has got a balance of 8,333. 8,333 is the balance, because out of this, no, he is getting 15,000 here. So, his balance will be 25,000. Let us come now to see what are the balances due. The balances due are nothing in creditors, A's loan is also not there, he has got 50,000 so far as A is concerned, B is having 10,000, C is having 25,000 for 1 share. Now, the third realization. Third realization is 54,000. How this 54,000 rupees will be distributed? That will be distributed only among the partners. So, for 1 share he is giving 25,000, for 2 share he is giving 10 shares means 5,000 each, 25,000, and for 3 shares means 16,667. So, at least to be equal to A, he should get 7,000, that is 25,000 minus 16,667, that is equal to 333, 8,333 first of all we have to give him. After giving 8,333, first let him take 8,333. Then his balance is coming to 16,667, this fellow 6,667 and this is 5,000 per share. We have already given 8,333 out of 54,000. So, we have got with us 45,667. Now, how this 45,667 will be distributed? This will be given first of all up to 11,667 he should get, 11,667 he should get, and the A should get 16,667 into 3. He should get 16,667, one partner, that is C should get 16,667 because that is the amount due, and A should get 50,000. But how he got this amount? And he should get 5,000. But we do not have that much of money. We have got only 45,667. So, let us distribute it in the ratio of A and C in the ratio of 3:1. So, it will be 3/4 and it will be 1/4. So, 1/4 of 45,667 divided by 4 is equal to 11,417. 11,417 he will get. C will get 11,417. He is there to get 11,667, up to that he can get in order to be equal to B's capital, but he is getting 11,417. 11,417. In this way, these two amounts will be given to him, and the remaining 11,417. So, 34,250 will have to be given to 34,250 will be given to A, and to B nothing will be given. So, this is the payment, how this 54,000 is adjusted. After that, let us see who is having how much. So, here it is coming to 15,750, it is 10,000, and it is coming to 5,250. They are having more capital in comparison to B again, because for 2 shares he is having 10,000, that means for 1 share it is 5,000, for 3 shares it is 750, means it will be given 5,250, 5,250. This is the contribution till now they have made. Now, we come to the fourth realization. In the fourth realization, we have got 7,000 rupees. So, out of 7,000, how it will be going to be distributed? First of all, we will give him 750 and to him 250, so that their balance decreases to 15,000, 10,000 and 5,000. Here you can see we have got minus 1,000. So, we have got 6,000 to be distributed to these 3 fellows A, B, C, but their capitals are 15,000, 10,000, 5,000, which is in their profit sharing ratio 3:2:1. Once the amount has come down to the profit sharing ratio, then there will be no difficulty in distributing this 6,000. That will be distributed in the profit sharing ratio. 6,000 rupees when will be distributed in the profit sharing ratio of 3:2:1, he will get 3,000, B 2,000 and C 1,000. So, in this way this 6,000 is adjusted. Now, what is the balance due? The balance due will be 12,000 and 8,000 and 4,000, and they are not going to get this amount, it is their loss. So, this balance due is called loss on realization. And what we have to see? we have to ensure that the loss on realization ultimately should be borne by the partners in their profit sharing ratio, and their profit sharing ratio is 3:2:1. Here it is 4,000, 8,000 and 12,000, which is in the ratio of 3:2:1. Therefore, this is the way in which it will be distributed, and this problem is completed here as we are getting the realization loss and there is no amount left to be distributed. This maximum loss method is applicable where there is the possibility of insolvency. This method is suitable when a partner or partners are insolvent or are likely to be insolvent. It is assumed that every installment of realization is the last. We may receive 1, 2, 3, 4, but after receiving the first we will assume that no other installments will be received. So, as a result of this, we have to see at that situation what will be the total loss, and the remaining assets will not fetch anything. Thus, the balance due to the partners less assets realized is the maximum loss. Whatever amount is due minus the amount received, I mean remaining assets will not fetch, maximum loss will be there when the balance due is more and the assets realized less. So, in each stage we will see that will be the maximum loss. But the thing is, after the first one, although there is the possibility of collecting the second one, we will not take it into consideration and we will find out what is the loss. That loss will have to be borne by the partners in their profit sharing ratio. If a partner's share of loss exceeds his balance due, partner's share of loss is more than the balance due to him at any stage. So, he is declared insolvent. If he is declared insolvent, his deficiency will have to be borne by the partners in their capital ratio. The other partners, these other solvent partners will bear this loss on account of insolvency of a partner in their capital ratio. So, accordingly we will distribute it. The same Garner versus Murray case will apply here also. For calculating the capital ratio, not only the balance of capital, but also accumulated profits and losses and drawings are taken into account as usual, that is in case of fluctuating capital. However, if the capitals are fixed, no adjustment is required. But the above process is repeated till the negative balance is abolished. When all the negative balances will be abolished, only positive balances will be there, that is the amount to be paid to different partners. The partner or partners showing credit balance are paid off first. This procedure is to be followed for all subsequent installments, and it may be noted that cash in hand is to be considered as the first realization. So, here is a question: sundry credit ABC are partners sharing profits and losses in the ratio of 3:2:1. This is their profit sharing ratio. Sundry creditors are 3,15,000, sundry creditors 3,15,000. Then capital accounts of ABC are 2,10,000, B 1,05,000 and C 20,000. Cash in hand is 50,000. Stock and debtors are there 1,60,000 and 4,40,000. Now, the partner decided that the net realization should be distributed at the end of each month as per rule. So, each month, that is first month, second month, third month, fourth month, fifth month, the collection amount where realized value in rupees was given to us. So, first of all, the cash in hand 50,000 will be given to the sundry creditors 50,000. Entirely it will be given we can prepare one table where before going to this let us prepare this one, the total amount realized, realization expenses, then creditors and partners, how they are going to receive it. In the first of all cash in hand is there, that is 50,000. As there is no realization expenses, it will be given to the creditors first 50,000, to the partners nil. So, out of 3,15,000 we have got 2,65,000 so far as the sundry creditors are concerned. Now, in the first realization we are receiving 1,25,000, but out of that there is an expense of 10,000. So, remaining 1,15,000 we can give to the creditors. 1,15,000 if we give, then it is coming to 1,50,000, nothing to the partners. Then the second realization we are having 1,88,600, out of which there will be expenses of 9,000. So, we have got actually 1,88,000 minus 9,000, which is coming to 1,79,600. But these persons, that is creditors, are having only 1,50,000. Give them 1,50,000, so their account will be closed. So, remaining will be 29,600, that will be given to the partners. 29,600 will be given to the partners. Then the next one, next realization will be 1,04,650. Third realization will be 1,04,650 minus 7,000. So, because the creditors have been given in full, 1,04,650 minus 7,000, let us take it 97,650, that will be given to the partners, 97,650. Then 1,14,750 in the fourth installment we are getting, but out of that expenses are 6,000. So, 1,08,750 is there to be distributed, and in the fifth one we have got 52,000, 4,000 is the expense. So, 48,000 we can distribute. So, in this way this will be the distributions 29,600 onwards. First of all we will be giving to the creditors meeting the expenses, and whatever is remaining that will be distributed among the partners in the proper ratio. So, coming to the balance due, the total will be 3,35,000. So, with these things 29,600, 97,650, 1,08,750 and 48,000, we will proceed the problem. First one will be amount due towards capital 2,10,000, 1,05,000, 20,000. So, from the first installment we are getting 29,600. First installment we are getting 29,600 for the partners, first realization. So, to whom we will be giving this 29,600? If the bonus due is 3,35,000, we are getting 29,600 only. What is the deficiency? What is the maximum loss? maximum loss will be 400, 3,05,400. These 3,05,400 rupees will have to be distributed in the ratio of 3:2:1, which is coming to 1,52,700. This is the maximum loss, 1,52,700, then 1,01,800 and 50,900. What we have done is, we have taken this amount to be realized and nothing will be realized, we are assuming. So, there will be a loss of 3,05,400. If that will be the maximum amount of loss, that will have to be borne by ABC in their profit sharing ratio of 3:2:1. So, in the ratio of 3:2:1, I have distributed 3,05,400, it is coming to this. Then out of that deficiency, what will be the deficiency now? Now, the deficiency will be this minus this will be the amount of deficiency. So, let us do it like this. From this we will deduct this one, so that the deficiency will be 57,300, this one 2,10,000 minus 1,52,700. This will be 57,300. This will be 3,200 and this will be minus 30,900. Now, this 30,900 is the deficit of C, which will have to be borne by A and B in their capital ratio, that is 2,10,000 is to 1,05,000, that is 2:1. So, that 30,900 when will be distributed in the ratio of 2:1, that will be 10,300 minus, and it will be minus 20,600. In this way the balance will be, and this will be plus 30,900. This deficiency will be made good like this. So, it will be now minus 7,100, it will be nil and it will be 36,700 plus. So, again B becomes insolvent and there is no other partner excepting A who will bear it. So, that amount will be again borne by A and it will be plus 7,100. In this way the position will be nil nil and 600 and 29,000. So, 29,600 which we have got will be first given to A. Now, when 29,600 is given, what is the amount due? 2,10,000. 2,10,000 minus 29,600 will be 1,80,400. And the amount nothing is given, so 1,05,000 is due to him and 20,000 is due to him. This is the case where we are going to the second, I mean the next realization. The next realization was 97,650. 97,650 is the last one. Let us take the total of this. The total of this is coming to 400 3,05,400. It is coming to 3,05,400 payable to A, B, C like this. Then we are getting 97,650. Out of 3,05,400, 5,400, if we are getting only 97,650, what is the maximum loss? Maximum loss will be 2,07,750. This 2,07,750 will be the maximum loss. So, here from this we will be deducting these amounts. 2,07,750 means it has to be distributed in the ratio of 3:2:1. So, it comes to 1,03,875. Then for B it is coming to 69,250, and for C it is coming to 34,625. Thus, a loss of or minus negative balance of 625, and this will be 625 14,625, which will have to be borne by the remaining partners A and B in their capital ratio of 2:1. Now, that 14,625 when will be made good by these two partners in their capital ratio of 2:1, it will be borne by A 9,750, this will be minus, and this will be plus 14,625, and here it will be minus 4,875. After bearing these losses, this amount is coming to 76,525, and this is coming to 35,750. Now, if you deduct all these things, then what is the position? The position is nil here, and this will be minus, means this will give you 30,875, and this will be 66,775. 66,775, and total loss will be 97,000. Total amount will be 97,650. 97,650. So, the second realization of 97,650 rupees will be distributed in this manner. So, as a result, what is the balance left? The balance left will be 2,07,750 So, this was the balance due 1,80,400 minus 66,775 will become now 97,650. Then the balance due will be 2,07,750 1,13,625 74,125 and 20,000, because nothing is paid to him. So, we are giving 74,125 sorry 30,875 we are giving, out of this it will be deducted. So, it will be coming to 74,125. Similarly, we are giving out of 1,80,400 we are giving 66,000. So, 1,13,000, this is the balance due. In this way, we have to carry on with the balances of each one, and then again we have to see what is the collection. Next collection is 97,650 is gone, 1,08,750. Next one will be 1,08,750. So, out of 2,07,750, if we deduct that amount which we are receiving 1,08,750, then there will be maximum loss of 0,009 here. 99,000 rupees will be the maximum loss. So, when maximum loss will be 99,000, how it will be borne? In the ratio of 3:2:1 again it will be borne. So, that will be 49,500. Then 33,000 and 16,500. So, in this way, after deducting this, whatever balance is there, it will be paid to them, and ultimately you will see after realizing the last one, the loss to be borne by them will be in their profit sharing ratio. So, that will be the loss on realization. So, it is the end of this chapter, that is insolvency of a partner. Thank you.